As the S&P 500 has notched its longest run of weekly gains since 2017, something is happening under the surface in the banking sector that is not exactly great. Great for who? I mean, we could make the argument for that. It could be good for investors like us. We'll talk about that here in this video. We'll break down everything that's going on right now with AMC stock and what I expect to transpire over the next, coming weeks and coming months. Hit that like button and subscribe to the channel. Thank you guys for tuning in, and let's go ahead and get started here. So I do want to point this out. Couple different things I want to point out over here first, but this one says, oops, a bank liquidity indicator sounds the alarm. Emergency loans from the Fed's BTFP facility keeps rising. This is Bank Term Funding Program. Rose another $7.6 billion week on week to $131.3 billion, a new high. Now, what this is essentially is, if you look at TLT used to be $150, right? That was because yields were low, bond prices were high. What's happened, or really what's happened over the last couple of years since 2020, everyone got this free money. It all went into the banking sector. What happens? Well, banks, they can't just sit on a bunch of cash. They have to either make loans or they have to buy treasuries. They're not allowed to buy stocks with customer deposits. They're not allowed to do anything else besides two things: buy treasuries and lend out money. That is it. So when they were flooded with trillions and trillions of dollars, there wasn't a lot of loans being taken out initially in 2020 and 2021. So what happened? Well, banks were forced to put money into bonds. Some banks hedged those bond positions. Some banks did not. Banks that did hedge the interest rate risk, well, they're still alive. They're still around. So most of them did. Some of them did not. Silicon Valley Bank, First Republic Bank, banks like that. And they were in a bit of a problem. Well, this funding term program, essentially what it is saying, let's say you're JP Morgan and you're seeing a lot of withdrawals because investors want to take their money out of bonds, out of their bank account, and buy stock. Let's say, for that matter. Let's say you have all these bonds that are underwater that you do not want to have to sell to fund your withdrawals. So what do? You go to the Fed and you say, hey, give me this loan at $150, the same par value that I bought the bonds for, because when they come to maturity, I'm going to get all my money back, but it might be 2 years from now. So you're just going to give me the money up front, and you're going to hold the bonds as collateral. When they mature, you'll get all of your money back. That's essentially, in English, what this program is. So the higher this goes, the more banks that are using this program funding these withdrawals, that could be a good sign of this great shift of capital, and capital ultimately heading back into our markets. Now, we have to wait and see, obviously, but this could either mean that or stress in the banking system. That's really it. So I would say stress in the banking system is, definitely moving higher here, or at least withdrawals from banks are likely moving higher. Now, something else I think is very important that we cover here in this video is the deflation argument. So right now, you're basically seeing deflation already happening, or at least getting close to that. Carl from CNBC says, welcome to Target PCE, because this is from Renaissance Macro Research. They say core PCE inflation is up 1.87% at an annualized rate over the last 6 months as of November. Between used car and truck prices and housing rents, there is room for inflation to remain benign. We continue to see the Fed cutting its policy rate in March. So you're under the Fed's target of 2% if you look at the last 6 months. Now, the next 6 months, well, by then, which that's going to put us by May, June-ish, you're going to be under 2% inflation, maybe even into deflation. According to Kathy Woods, deflation could be coming. Yikes. Kathy Wood of ARK believes deflation is likely in the coming year, expects aggressive interest rate cuts by the Fed. Now, this is good to a certain extent, but deflation is ultimately bad because, sure, you're getting, lower gas prices. You're getting, lower cost of toilet paper, lower cost of paper products or food or whatever it is, does not matter. But if you're getting lower cost, that means companies are bringing in less revenue. That means companies are likely to start laying people off. Does that feed into a recession? Normally, yes. This time around, maybe, maybe not. But I'll tell you, deflation is not a great thing for the economy. It might feel good, at least initially, but if you start, if you lose your job, that deflation doesn't matter because you don't have a job and now you're not making any money, right? So we definitely want to be watching for this. Recession fears could come about if deflation really does start to take hold. And I think a lot of this is going to come down to housing. If housing inflation does continue to fall, we've started making some progress, but if housing really falls from here, you're going to be in full-blown deflation quickly. Morgan Stanley's outgoing CEO, James Gorman, said financial markets will take off once investors are sure the Federal Reserve has finished raising interest rates, the Financial Times reported on Friday. Now, we'll talk about this a little bit more in the next video as well, but this is essentially because there is so much cash on the sidelines, around $20 trillion of cash on the sidelines that likely moves back into markets. Now, for a stock like AMC, this could be very much great news because there's really one thing that has been affecting stocks that have been, down big over the last 2 years or so. There's one thing. That's liquidity. There has not really been any liquidity in our markets for a long time. That's because it's like every month there's just less money coming out of stocks, as simple as that. And the money that is in markets, that is driving markets to new highs, it's not because there's more money in stocks today than there was in 2021. There's less money in stocks today than in 2021. But the money has moved into your Magnificent Seven, your highly concentrated names in the SPY and the QQQ. But your names that, are just average names have not done that well because of this, liquidity really crisis that is going on and has been going on. So, that might start to change in 2024, and that might be a great thing for stocks such as AMC as well. Something we definitely want to be watching for, as AMC is basically hitting new yearly lows almost every single day. We did see a green day on Friday. AMC stock was up about 0.5%. Now, in the very near term, I am expecting some form of pullback for the indexes, for the SPY, for the triple Qs. I think that has to happen essentially at this point. Stocks do not just go up in a straight line forever. They will come down. Now, how far do we come down, I think, is a bigger question. Could we fall to, our prior all-time highs that we seen back in November of 2021 or December of 2021, I shall say, around 465 in the SPY? Yeah, I think that's probably likely. Could we fall back to the highs in July around 456? Probably. Now, what do I think is personally going to happen is we are going to see a pullback in the markets. We could fall lower than our July highs if your Magnificent Seven stocks really do start to underperform. Now, this might sound crazy to you guys, but you could see 95% of other stocks doing well, rallying, and your top 5 stocks doing poorly. And you could be experiencing a correction at the same time because your top 5 stocks have the highest market weightings in the S&P. Really, your top 1% of stocks, Apple, Microsoft, Google, Amazon. If the air comes out of those bubbles, the indexes are going to fall quickly. But where's that money going to go? Is it going to go into treasuries at this point? Maybe some of it. Is it going to go into interest rate sensitive names? Names like a Tesla, names like a Fubo, names like a SoFi, a PayPal, even an AMC for that matter, being interest rate sensitive. That's what I would expect to happen. So I think in the very near term, you probably get a pullback in the markets. I'm saying between now and the next 3 months or so, but it does not have to be a broad-based pullback. It could be just a pullback of the Magnificent Seven stocks that are trading at record high valuations, really vulnerable for a pullback. And that money might go into some of the beaten down dog stocks that have a much greater chance of outperforming coming next year. This is also something we'll talk about in the next video as well. But it looks like the IWM has now just gave us confirmation of a further rally. Tom Lee does also agree with this. This is from Mark Newton. Mark Newton is the global head of technical strategy at Fundstrat. He says IWM finally managed to achieve its long-awaited weekly close above prior peaks going back to the spring of 2022. And this is, just very obvious here. If you break out of a multi resistance line where you hit resistance over and over and over and over again, and you finally break out, that usually leads to much higher prices, right? That's just how things tend to happen. So with AMC, I think AMC will ultimately benefit from this, but it really comes down to dilution or not. Do we continue to get more dilution or do we not? I personally think I'm not selling AMC, right? You're way too far past at this point, in my personal opinion, to be selling AMC unless you still have a lot of money in the name, like a ridiculous amount of money that you think could be better invested elsewhere. But I'm not actively buying AMC into all of this dilution. Let me just be honest with you guys. I am, not selling AMC, but I'm not buying AMC. I'm not really not buying any other stocks right now. I've been buying other stocks for ever. I've never only been just in AMC. So I think that's important. You can manage to hold some of your losses in AMC if you do have other stocks that are performing for you. I think that's a very important thing that we need to get over as a community here. It is okay to own other stocks. It is okay to make profits in other stocks. Do what you want. Make profits in those stocks, sell them, put them into AMC. It doesn't matter. I don't care. Do what you guys want to do. I'm not a financial advisor. This video could be phony baloney, and I could be completely wrong. Stocks could go to 6,000 on the S&P, and I would just be wrong. We never got a pullback, and Magnificent Seven continued higher. As Dan Ives thinks, Apple is going to become the next $4 trillion company in 2024. Maybe that happens. Maybe it doesn't. It's all up to you guys to come to your own conclusions, figure what makes sense to you, and put that plan that you formulate into action. But I do think if we get no more dilution, we get a confirmation of this from Adam Aron, the AMC stock will start to perform as we expect it will or hope it will. But if we don't get any guarantee of no more dilution, AMC stock is probably going to trade in this range for a while. Could you trend back to $9, $10 per share? Sure. Until you get diluted again. That's the big problem that I have right now. But I do think AMC stock is still hundreds of percent sold short. So do I want to sell it? No. Do I think there could be a squeeze? Yes. Do I think there will be a squeeze when AMC is actively being diluted? At least not for a while. I think you would need to get rates back down to, 2-3%, more accommodative, more friendly to liquidity in stocks before you could see a squeeze at the same time Adam Aron is diluting shareholders. That's just my thoughts. Let me know what you guys think down below in the comment section. Thank you guys for watching. Enjoy the rest of your day, and I will see you in the next one.